Inflation is here to stay, right? The days of, sub 2% or anywhere near 2% inflation are over. We're now going to pay the piper for decades of inflation that central banks have created.
In today's video, Peter Schiff, founder, CEO and global strategist of Euro-Pacific Capital, gives a warning that the 2008 crisis was just the prelude to a larger sovereign debt crisis in the United States that may lead to a collapse of the US dollar. Before listening to him, please ensure to smash the like button and subscribe to the channel.
Well, first of all, you have to realize that we have erected an entire phony economy on a foundation of inflation. So if we're going to rid the economy of inflation, we have to be prepared for that entire structure to topple. So there's going to be a lot of bankruptcies, there's going to be a lot of losses, there's going to be a lot of unemployment. A lot of things are going to happen. It's not that you have to cause all this to stop inflation. It's just that if you do stop inflation, all this is going to happen, because all of this was the result of inflation. Every time we've had a problem, the Fed's solution has been create more inflation. Well, now the problem is inflation, right? The solution has become the problem, and you can't solve that problem with the same solution. You have to acknowledge that everything you did in the past to solve the problem actually made the problem worse. It just postponed the consequences until the future, and we've caught up with it, right? We kept kicking the can down the road, and now we've caught up to the can, and there's no more road. So we have to be prepared for the collapse, but also we have to understand that inflation is not here by accident. Inflation is a method by which government pays for spending. Governments can pay for spending through taxation or through inflation. And our politicians and a lot of other politicians have chose inflation. Why? Well, because the public doesn't realize that inflation is a tax. If the government raises taxes to pay for spending, then the public gets mad because they see the money coming out of their paychecks and they know where it's going. It's going to Washington. So what happens is we run these big deficits. Governments spend a lot of money. They don't raise our taxes. But now, because they're printing money instead of just taking our money, but they're spending that new money into circulation, the price of everything goes up. We just don't realize that that's a tax because the government can blame it on Putin, or they can blame it on COVID, or whatever they want, greedy corporations gouging their customers. So if we want to stop taxing the people through inflation, we have to either tax them another way, or we have to cut spending. In other words, we have to balance the budget, the opposite of what they just did. I think yesterday they just passed this omnibus spending bill, another $1.7 trillion. That's throwing gasoline on the inflation fire. So in order to fight inflation, the government is going to have to come clean and either raise taxes dramatically on the middle class and the working poor, which I don't think is a good policy. The alternative, a better policy, is to cut government spending. But it has to be widespread spending across the board. I mean, we just gave another, $45 billion check for the Ukraine.
Yeah.
We don't have that money. We should be trying to get peace in the Ukraine, not funding war with money that we don't even have. I mean, if we're going to war against inflation, we can't do this. But we have to cut spending on everything. Medicare, Social Security, Obamacare, government pensions, military. We have to cut back on what we're spending on the military, right? Instead, we're spending more. You have to vote to raise taxes. So politicians always take the easy way out. So they want to spend money, and then they want to blame the inflation on somebody else. And that's what they're doing now, and that's what they're going to continue to do.
So you think Congress needs to spend less money? Congress needs to just spend less money for inflation to come back down?
Yeah, unless we get cuts to government spending, inflation is not going to come down. And of course, the other thing that has to happen is that interest rates have to rise to a level that exceeds the inflation rate by a comfortable margin.
Yes, I heard that.
Because what needs to happen in order to bring down inflation is we need people to stop spending and start saving. And so why would people save? Well, if they can earn a yield that exceeds the inflation rate, then they're going to get paid to save. Then they'll do it. But if you still hold interest rates below the inflation rate, nobody's going to be dumb enough to save. Everyone's going to spend their money as soon as they get their hands on it, and that is going to make the inflation problem worse. Also, when you look at prices, you have two things going on. You have demand, but then you also have supply. And so demand is being fueled by money printing and spending, but we need more supply. Well, if we have less spending and more savings, you kill two birds with one stone, because that reduces the demand, but it increases supply, because the money that is saved is then loaned out to businesses to make investments in capital that can increase productivity. So by encouraging savings and discouraging spending, we get less demand and more supply, and that helps reduce prices. But we're not doing that. We're not getting extra savings, so we're not getting additional supply.
Yeah.
And consumers are running up their credit cards, their all-time record highs, maxed out on mortgage debt, maxed out on auto loans. Everybody is borrowing and spending. So prices have got nowhere to go but up. Except I think they're going to have to come up with another word, because what we're going to experience is going to be much worse than the 1970s. I've been calling it an inflationary depression, because it's going to be much worse than a recession. It's not, and it's going to be very high inflation. So during the 1930s, we were on a gold standard, so we had real money, and so we had a depression, but prices came down. And prices coming down was actually a good thing. It provided some relief to people because the cost of living went down, the value of money went up. But a lot of people think that the reason we had a depression was because prices went down, which is not true. Prices went down as a result of the depression, but it didn't cause it. And in fact, it did provide some relief. But the whole idea that if prices are coming down, we should worry that it might cause a recession is nonsense. It's like trying to blame the rain on wet sidewalks. They have it in reverse. But what's going to happen during this inflationary depression is going to be very different, because we're not on a gold standard anymore. We're on no standard. We just have fiat, and the government's going to print even more of it to try to prop everything up and bail everybody out and prevent politicians from having to make the difficult choices of cutting government spending. They're just going to print money and give it to the government so they can spend that. So it's going to be very different. I think that the nominal level of a lot of stocks, those prices are going to go up for a lot of stocks. But in real terms, if you price them in gold, they're still going to go way down. So stock prices are going to come down in terms of real money, but they're going to go up in terms of funny money. Now, some companies' stock prices won't go up, because these companies are going to go bankrupt. And so they go out of business, the stock is zero.
Which sector is going to go bankrupt most? Which sector is going to go bankrupt?
Well, the companies it's not necessarily any specific sector. Companies that don't make a profit, that aren't going to be able to survive. And also companies that are relying on advertising, that don't really have a product that they price, but they're just like living off now they might not go bankrupt. Maybe they can reinvent themselves on a smaller scale and try to find a way to pay the bills. But also there's a lot of companies that are going to have to downsize or reduce their scale to try to find the point where they can operate properly, on a smaller scale. But there's been a lot of stocks too that were so inflated during the bubble that they still need to fall dramatically. Even if inflation is there, the prices of these stocks still have to come down a lot. But there are a lot of companies that the stock price is going to go up. Now, unfortunately, most Americans don't own those stocks, or they don't have a lot of money in them, because they have all their money in the bubble stocks, because the bubble stocks were the ones that were delivering the best returns on paper, and that's what everybody was chasing. And unfortunately, those stocks dominate the indexes. So it's possible that the S&P 500 could end up lower at the end of the decade because of the weighting of those stocks. But within the S&P, within those 500 companies, there's going to be a number of them that go up. The key is to just buy those. I mean, that's one of the reasons they did go down. I mean, stock prices are inversely valued based on interest rates. I mean, that's just basic stock market, because in essence, a stock is the present value of its future earnings. And in order to determine the present value, you have to discount it by an interest rate. And the higher that interest rate is, the lower the present value of those future earnings become. So all else being equal, if interest rates go up, stock prices should come down. And in fact, that's what happened. And the same thing with bonds. Of course, we all know that if interest rates go up, then bond prices come down. They're the opposite of rates. And that's what happened. Then, of course, bonds, do represent some type of competition for stocks. People can buy bonds or stocks. And so, if bond prices are falling and the yields are rising, then, stock prices could fall as well. In fact, one of the reasons that they kept saying the stock market wasn't overvalued is they kept comparing it to the bond market, which was also overvalued. Well, now they're both coming down, and they both have a long way to fall. In fact, I think there's more risk in the bond market than there is in the stock market. Well, first of all, the present value is not cash flow, but earnings, because cash flow doesn't mean anything if I don't have a profit, right? So I got to make money. And then I have to use that money to either buy back stock or pay out dividends. But I have to, distribute the returns to investors. But yes, you're right. I mean, and in an inflationary environment like the one that we're in and that we're going to be in for a long time, you want to own companies that are selling products and services that people need and they will pay for. They will continue to buy even if the price goes up. They will give up other things in order to keep buying what you're selling. And to the extent that they have to cut back on how much they buy, they're still going to buy something, even if they buy less. Whereas there are a lot of companies that are selling products that people only buy after they buy all the things they need. Then, if they have any money left over, they buy these other things that they want. You don't want to own the companies that sell those things because they could lose their entire business. Right? People just give up because they don't have any money left over. After you pay your rent, after you pay your electricity, after you buy the food, pay your insurance, pay your taxes. I mean, pay all the things you have to do. If there's nothing left over, well, there's nothing left over. And if you can't go out and borrow it anymore, there's no credit floating around anymore because everything is tightening up. Well, a lot of these companies are going away. So you want to own companies that have pricing power, but also in an inflationary time period, you want to own real stuff. You want to own companies because they own real assets. They have resources, they have plant and equipment, they have things that have value that will hold value even as paper claims are losing value. So I'd rather own equity in the company than be a bondholder, because what inflation ends up doing is it ends up transferring wealth from creditors to debtors. So I'd rather own the company than the bonds of the company, which are going to be eroding away in value because of inflation. My problem is I saw it too clearly and I saw it too early. But at least I saw it, because most people still have no idea what's coming, and they're they're going to die in this wreck. I'm all buckled up and ready to go. But so I own value stocks. I own dividend paying stocks, and they've outperformed dramatically this year and over the last several years, and I'm quickly catching up to the underperformance for the last 10 years. I mean, I've actually, if you look at me relative to my peers in international investing, I'm now at the top of the pack over the last 3 and 5 years. So I made up a lot of lost ground, but I still have ground to cover to catch up to the S&P. But I'm quickly, catching up, and I think maybe by the end of next year I'll surpass it over a longer time period, because air is quickly coming out of the bubble, and I think there's going to be a gaping hole in that bubble next year. So a lot more air is going to come out. But I own non-U.S. stocks mainly because I think the dollar is going to weaken, and I think we have a lot of political uncertainty here as a result of how the government is going to react to how bad the economy is going to be. So I'm worried about regulation and taxation. So I think it's less political risk in the countries I'm investing in abroad. Much better valuations. The stocks are much cheaper. The dividend yields are much higher, and I'm getting revenue in foreign currencies. I own a lot of resources. Energy, which has done very well, obviously this year. But I've been in energy for a while. But also minerals. Agriculture, emerging markets, which I think are very cheap right now on a relative basis compared to the developed markets. So I think those stocks are going to do very well in an inflationary decade with a weak dollar. We could end up breaking that range in both directions. Maybe we'll go below 7% before we go above 10%. But I think we're going to take out the highs from 2022 before the end of 2023 on a year-over-year basis. But even if we don't take out the highs in 2023, we'll take them out in 2024. I mean, inflation is here to stay, right? The days of sub 2% or anywhere near 2% inflation are over. We're now going to pay the piper for decades of inflation that central banks have created. And now we're going to have to deal with the consequences.